Are you missing out on the massive opportunities in today's booming commodity markets? In this video, we'll explore an important financial instrument that plays a vital role in modern markets: commodity derivatives. Let's break it down for better understanding: what they are, how they work, their types, benefits, and the risks involved. Commodity derivatives are financial contracts that derive their value from an underlying physical commodity. These commodities can be, agricultural like wheat, cotton, or soybeans, energy such as crude oil or natural gas, and metals like gold, silver, or copper. So, commodity derivatives actually serve two major purposes. First, there's hedging, which is used by producers, exporters, and importers to protect themselves against price volatility. And second, there's speculation, which is mostly for investors and traders who are looking to profit from price movements. For example, a farmer might lock in a future price for his crop using a derivative. This way, he can ensure a predictable income even if market prices happen to drop later on. There are mainly four types of commodity derivatives. Alright, so let's talk about futures contracts. Basically, a futures contract is an agreement to buy or sell a commodity at a future date and at a pre-decided price. These contracts are actually traded on regulated exchanges like MCX in India or CME in the USA. Now, moving on to options contracts. An options contract gives you the right but not the obligation to buy or sell a commodity in the future. They're often used to limit potential losses, which is pretty handy for risk management. And finally, let's discuss forwards contracts. These are customized, over-the-counter contracts made directly between two parties. They're not traded on exchanges, and honestly, they carry a higher risk because there's a lack of regulation. Swaps are basically agreements to exchange cash flows based on commodity price movements. You'll often find these being used in the energy sector, like oil and gas. So, let's say a gold mining company expects to produce 100 kilograms of gold in about 3 months. If the current price is 6,000 rupees per gram, but they're worried that prices might fall, they can actually enter into a futures contract today to sell at this rate. Now, in 3 months, even if the price drops to 5,700, they still get to sell at 6,000, all thanks to the derivative contract. In India, commodity derivatives are regulated by SEBI, that's the Securities and Exchange Board of India. So, the major platforms in India include MCX, which stands for Multi-Commodity Exchange, and NCDEX, or National Commodity and Derivatives Exchange. And if we look globally, the Chicago Mercantile Exchange, or CME, is definitely one of the leading players. Now let's talk about some benefits. First, there's price risk management, which helps you deal with fluctuations in commodity prices. Then there's portfolio diversification, so you can spread your investments and reduce risk. And, of course, leverage, which means you can get greater exposure with less capital. But, there are also some risks. High volatility is a big one, since prices can change really quickly. Plus, leverage can magnify your losses, not just your gains, so you have to be extra careful. So, you see, education, strategy, and discipline are really crucial when dealing in commodity derivatives. So, let's talk about some real-world trends as of 2025. We're seeing increased participation by retail investors through online trading platforms. There's also a growing use of AI-based analytics to predict commodity price movements. Plus, there's rising demand for green commodities like carbon credits and lithium. And of course, cross-border trading and real-time settlement are now possible using blockchain technology. Commodity derivatives have really become a critical part of the global financial ecosystem. They offer tremendous potential for both hedging and investment, but just like any financial tool, they require understanding, risk control, and informed decision-making. If you're planning to trade in these instruments, always consult a registered financial advisor or, take certified training. Thanks for watching. If you found this session helpful, don't forget to like, share, and subscribe for more such educational content. Drop your questions in the comments, and until next time, stay informed and trade wisely.